Hey everybody, Smart Silver Stacker here. I want to talk to you today about a disturbing trend that is beginning to manifest in Europe, and it's a symptom of the deepening energy crisis across the EU. And what I'm talking about is a stagflationary spiral. Now, yesterday, French energy giant Total Energies, they sat down with workers' unions to start a fresh round of wage negotiations. And the purpose of these talks is to attempt to end a strike of fuel refinery workers in France that has been disrupting the supply of fuel to their gas stations or petrol stations, as they call them. And the crisis has made getting fuel difficult, and it's also been bad enough to force the government there to tap into their strategic fuel reserves. Now, the unions, they want a 10% pay raise for workers, and French President Macron has now instructed Total Energies to pay the workers more, so maybe they will come to some kind of an agreement. But the more important thing here is that this situation between Total Energies and its workers, this is just the beginning. This is a symptom of a larger stagflationary spiral which is now forming. Because companies in the EU, they're going to be forced to pay higher wages to keep up with inflation, but at the same time, they're also facing higher costs for energy and raw materials, and also they're being forced to pay more interest on debt service as interest rates are rising. So companies have been getting squeezed by all of these rising costs. And one of the ways that they've been keeping pace with that is by raising prices. But now we just got this report from Eurostat on October 6th that shows that retail activity across the EU is beginning to decline in a pretty serious way. In August, it was down 1.2% year over year, and it was down 0.2% from July. So what this tells us is that demand is softening across the EU, and that means that raising prices is no longer going to be a strategy that these EU businesses can rely on. And so what we are likely to see is that rising wages, along with all these other skyrocketing input costs, it's going to destroy the profit margins of these businesses. And that means that their earnings are going to get destroyed, and that means cutting the fat, layoffs, closures, anything to get costs under control. And we're already beginning to see this among big European retailers. H&M, that's the world's second largest fashion retailer, and they do the bulk of their business in Europe. They recently announced their Q3 earnings at 680 million Swedish krona, and that was against an expected 2.98 billion. So that was a huge miss, and as a result, they have begun a cost-cutting program of 2 billion krona, and that comes out to about $177 million. And this whole thing can quickly turn into a downward spiral because layoffs and cost-cutting, that means that workers are going to have less cash to spend, so that means demand is going to soften even further, means earnings will decline more, and that will be followed by more layoffs. And you see how this works and how this can get out of hand pretty quick. And when all of this really does get moving in earnest, central banks and governments, they're going to be forced to intervene because, let's face it, they always do in a recession, at least, in modern history. But nothing in the toolbox of governments and central banks, short of maybe eliminating some of the sanctions that are ongoing, is going to fix the fundamental problem here, which is an energy supply shortage. Instead, their intervention, should they choose to intervene in the conventional manner of throwing printed fiat currency at any problems that pop up, it's going to make the inflation problem that Europe is currently experiencing much worse. But it won't end the recession in any meaningful way, and that is how we get stuck in the mire of stagflation. So it's time to get prepared for that, whether you are in the EU or in the US, because this crisis, it's not going to remain isolated in the EU. It might hit them first, but it will come to the US eventually, even if there is some lag. And for those of us with US dollars and who earn US dollars, we're pretty fortunate at the moment because the rising US dollar index, it's now pushed gold and silver back down in dollar terms. And that is still my pick for the asset that will do best in this stagflationary environment we are heading into. We got the inflation numbers for September yesterday. They came out hotter than expected, surprise, surprise. And again, markets and investors, they're getting this signal wrong because they seem to think that it means that the Fed is going to raise rates and fight inflation at any economic expense. And they're right in one sense, in the sense that the Fed will likely continue raising rates, and it is going to bring economic pain in this over-leveraged environment. But the real signal that these inflation numbers are sending us, that investors seem to be ignoring, is that what the Fed is doing isn't working. Because to really fight inflation, the Fed would have to act much more aggressively than it is. They haven't even gotten the Fed funds rate to a point where we have real positive rates yet. And look at the quantitative tightening. They've reduced their balance sheet by something like 2%, And already we're seeing rates on US Treasuries moving near unsustainable levels. So the bottom line here is that inflation is going to get much worse. It's already baked into the cake at this point. And the Fed's plan seems to be to create a recession in the hope that it will drive inflation lower, but instead they're just going to get us stuck in this same stagflationary nightmare. And so, in all likelihood, the cost of just about everything is going to keep going higher. And in the long term, metals will do what they do best, which is preserve value. And of course, nothing in these videos is financial advice. I'm not a financial advisor. I'm just a guy on YouTube. But to me, it seems like we should all be doing whatever we can to get prepared for this. We're lucky that we still have some time to do so. And what that looks like, it's going to be different for everybody. I mean, if you've got some disposable income that you want to save, maybe that means buying some gold and silver. Could also mean just paying off your debts and getting as resilient and anti-fragile as possible. It could also mean laying in some extra preps, some supplies, some food, beans, bullets, and band-aids, that sort of thing. But we do have some tough economic times ahead of us. So now is not the time to become complacent and dig our heads into the sand and just hope that the powers that be will take care of us, which is, I think, the route that the majority of people in our society are going to take. It is time to position ourselves so that after this economic winter passes and we get through this, that we're going to be ready to jump on the opportunities that present themselves in the spring. Leave me a comment down below to let me know how you're getting prepared. Thank you all very much for watching. Smart Silver Stacker, out.